Welcome to Cotality's housing market update for May 2025, our first monthly update under our new brand. February's rate cut led to a clear improvement in housing market conditions, but that positive influence now seems to be losing some of its potency. After a 0.4% rise in March, the pace of gains slipped a little, back to 0.3% in April. At the same time, household confidence dropped in April, with the Liberation Day tariff announcements and the federal election causing some uncertainty. We also had 2 consecutive long weekends through April, which saw many Australians on holidays. This slowdown in conditions was evident in auction markets, where the clearance rate averaged 60% over the month. The flow of new listings added to the market was also low. Apart from the early COVID period of 2020, new listings through April were at their lowest level for this time of the year since 2019. With further rate cuts expected as soon as May 20th and a level of certainty returning to the market following the federal election, we expect a further but modest growth level in housing values through 2025. The annual pace of growth provides a clearer view on how capital gain trends have evolved, with the 12-month change nationally slowing to 3.2% in April, the slowest annual rise since the 12 months ending August 2023. The loss in momentum reflects the persistent slowdown in value growth seen between mid-2024 and early 2025. Given the softer growth trajectory through last year, the annual pace of gains will continue to soften over the coming months, despite the positive movement in values since February. Although housing values are recording a broad-based rise, not every market is back to new record highs. In fact, across the capital cities, it's only the mid-sized capitals where home values are at their highest level on record. Sydney values remain 1.1% below the September 2024 high. Melbourne values are down 5.4% from the peak in 2022. Hobart is down 11.1%, while in Darwin and the ACT, values remain 2.7% and 6.4% below their all-time highs. From a rental perspective, rental growth has firmed, with the National Rental Index rising by 0.6% consistently over the past 3 months. Adjusting for seasonality, the pace of growth is milder, with rents rising 0.4% nationally in April. Despite the seasonal pickup, a slowdown in rental growth is more evident in the annual change, where the pace of growth has more than halved, from 8.3% over the 12 months to April 2024 to 3.6% over the most recent 12-month period. With rents outpacing housing values, the national gross rental yield reached a 2-year high in April, coming in at 3.73%. Gross yields across regional Australia remain substantially higher at 4.41%, but they're down on the levels seen 5 years ago when the gross yield of 4.83% was recorded. Sydney home values are up 0.2% in April, taking the market 1% higher over the past 3 months. That's the strongest 3-month gain since August last year. Despite the rise, Sydney home values remain 1.1% or approximately $13,700 below the record high set in September last year. The upper quartile of the market's been leading the recovery trend, with values up 1.4% over the past 3 months, while lower quartile values have gained a smaller 0.5%, reversing the trend of the last couple of years where the more affordable markets were leading the upswing. From a rental perspective, Sydney rents rose by 0.7% over the month, a lift from the 0.6% rise in February and March. However, the annual change in Sydney rents at 1.9% is the lowest annual change in 4 years. The outlook for housing markets continues to evolve, with a mix of potential positives and negatives at play. On one hand, we have the prospect of lower interest rates and stimulatory housing proposals from both Labor and the Coalition, which are expected to buoy demand. Also, a persistent undersupply of housing is likely to keep some upwards pressure on values. A gradual reduction in interest rates will support housing sector activity, but lower rates are also likely to embolden prospective sellers and support new housing supply. Previous research from Cotality shows that historically, it's been the upper quartile sectors of the market, especially in Sydney and Melbourne, which have been the most reactive to rate cuts. With Labor having won the federal election with an expansion of the 5% deposit guarantee, a key pillar of their platform, one thing seems certain is that first home buyers will see some further assistance to access home ownership, meaning first home buyers will comprise a larger share of the market as stimulus becomes available. The housing undersupply isn't getting any better, with commencements moving in the wrong direction. Building activity to December showed dwelling commencements were down 4.4% over the December quarter last year, holding 16.5% below the decade average. Additionally, the barriers for building more homes remain substantial, with construction costs rising a further 0.4% through the March quarter. On the downside is stretched housing affordability, a relatively cautious lending sector, normalizing population growth, and some uncertainty creeping into the measures of consumer sentiment and the outlook for economic growth. With housing values once again trending higher, housing affordability isn't improving. At the end of last year, the national dwelling value to household income ratio was on par with record levels, while home loan serviceability was also at an all-time high. Additionally, it would take a household on the median income an average of 10.6 years to save a 20% deposit, and for rental households on the median income, they'd need to be dedicating a record high 33% of their pre-tax income to pay the median rent. With housing affordability this stretched, accessing the housing market remains a real challenge, especially for first home buyers and lower income households, regardless of any proposed stimulus. Population growth, which is a proxy for housing demand, has fallen back to the decade average of 0.4% per quarter. Less population growth should help to take some heat away from housing value growth, but there's still a substantial undersupply that's accrued over the past few years. Consumer sentiment and the volume of home sales have shown a long-term relationship, which is unsurprising given the high commitment nature of buying and selling a home. In April, consumer sentiment was dented due to the announcement of US tariffs on the rest of the world, with some backpedaling from the US, including a pause on tariffs, excluding China, along with widespread expectations of further rate cuts and ongoing tightness in labor markets. We could see sentiment once again moving higher. A further rise in sentiment would be a positive for the housing sector, helping to support high-commitment decision-making. Overall, housing values are expected to continue rising in the short term, albeit at a softer pace than in early 2024. The outlook is subject to change as global and domestic events unfold. However, April reinforced the idea that uncertain environments tend to weigh more heavily on sales and listings than on home values. This is underpinned by a strong lending environment, tight labor market conditions, and a persistently low level of mortgage arrears. With lower interest rates on the horizon and an ongoing trade war, there's plenty to keep an eye on through May. While the brand may have changed from CoreLogic to Cotality, we continue to publish Australia's leading housing market insights and metrics. For now, these are still available at the news and research pages of the CoreLogic website.